We thank God. Trying to be.
All
Yeah.
is well. All is well. All is well. So, okay, I think we can start the class now. So, good evening, everybody. Our topic for tonight is IAS 19, employee benefits. And just like I said, let me repeat it once again. There are some four standards that are very, very important in the final level that going to the exam, we need to like take note of them. Number one is IAS 19. Number two is IFRS 2, share-based payment. Number three is IAS 21. Although IAS 21 has been moved to skill level, and IAS 8. IAS, IFRS 8, operating segment. So these are four standards that are not tested in skill level. So,
Sorry,
and if you can,
the fourth one. Sorry. I got IAS
IFRS
19, IFRS 2, IFRS 8. The fourth one.
IAS 21,
Okay, thank you.
IAS 21. Although IAS 21 has been moved to skill level, so we should all keep. Then we have IFRS 6. IFRS 6 is exploration for evaluation of mineral resources. However, that one it is very rare for them to test it. But during revision, we discussed about it. It's just a small standard that within 30 minutes, it is very, very easy. So those are the standards that at least they can come out because they are not tested in skill level. So examiner will definitely, or the chances of testing it is very high. So apart from that, we now have the key standard, which are IFRS 15, IFRS 15, IFRS 9, financial instruments. Then we have IAS 12. These are the key standard in the syllabus. And if you look at last diet, IFRS 15 came out, IFRS 9 came out. So those are the key standard. So just that's just by the way. So let's start today's lecture. Um, IS 19, employee benefits. So what is employee benefits? The standards, the definition. Just like if you look at your group, there is one acronym that we send to the group that someone introduced that we when we look at it that is going to benefit everybody. So which they are called dreams. D is for definition, R is for recognition criteria, then uh, E, then A and the likes, M measurement and the like. So definition of employee benefits, these are consideration, all forms of consideration given by an entity to an employee in exchange of service rendered by the employee. So all forms of consideration given to an employee by the entity. All of us, we all have businesses or we are working. So when we are working, we are expecting consideration. So all forms of consideration given by an entity to an employee are called employee benefit. So the standard talks about four categories of employee benefits, which is number one, short-term employee benefits. Short-term employee benefit, just by the name, short-term employee benefits are benefits other than termination benefits, which are payable within 12 months, right? Just like our salaries, wages, paid annual leave, paid sick leaves. So housing allowance, they are short-term employee benefits because they are payable within 12 months. And the standard um quickly just discuss about short-term employee benefits is that the recognition of employee benefit is to what is to just to recognize it in, let me just enlarge my screen a little, so okay, so that it will be clear. uh it's just to recognize employee benefit as an expense in the profit or loss account in the period when it was incurred. So also measurement of short-term employee benefits. These are benefits that should be measured based on the amount that is expected to be paid to the employee for service rendered. So that is all about that. So apart from short-term benefits, we have other long-term benefits, then we have termination benefits. So if you look at the standard does not talk so much about these benefits. The first thing the standard talks about is the short-term employee benefit, which is the one popular that we know, wages and salaried and the likes. So other types of employee benefit is what is other long-term benefit, that is a benefit that will be paid for more than 12 months. If you look at it, for more than 12 months, that is 12 more than 12 months, that is long-term employee benefit. Then we have termination benefit. So let me quickly talk about termination benefit just by the name termination. So this is a benefit that is payable to an employee when the employment contract is terminated. So the standard just talks about it. So in fact, when you check past question or in ACC or the likes, you cannot see a question that they are going to be asking you what is termination benefit. So the key part of IAS 19 is about post-employment benefits, and that's where we are going. Post-employment benefits. So, and what is post-employment benefit? Post-employment benefits are benefits other than termination benefits or other long-term benefits that are payable to the employee after completion of the employment or retirement. That means pension plan. So post-employment benefit is something that we are all conversant of. That there are some organizations, when you work for them for maybe 20 years or 30 years, they are just going to give you a benefit. Those are post-employment benefits. But the most popular one is pension plan, which is a benefit payable after retirement. So pension plan is sometimes regarded as post-employment benefit. So it is the popular benefit that we all know that, okay, it is post-employment. So now, how does post-employment benefits works? Let me quickly explain before we now start going deep. Before we start going deep, how does post-employment benefits work? So post-employment benefits, we all know that it's like a pension. It's after the end of your employment or after doing your retirement. After when you are in retirement, that's when you are going to be entitled to the post-employment benefit. So now, what the standard is now saying is that how are we going to account for this? Currently, you as an employee, let's say Mrs. A is going to retire at the end of 30 years in service. Is it at 5 years in service? Let's say 35 years in service. And we are 35 years. Thank you, man. So we are let's say at the end of 5 years now. So we still have more 30 years. So how are we going to plan for your benefits after 30 years? So that is why IAS 19 was introduced. That how are we going to plan for it? Because we must keep that money aside so that after 30 years you are going to collect your retirement benefit. Now, how does post-employment benefit works? And now this is it. This, if you look at this note, let me just read this note so I can now break it down. They said this consists of pool of assets together with a liability for pension own. It consists of investment, cash, and sometimes properties. The return earned on the asset is used to pay pension. Now, we said someone is going to receive his or her benefits in the next 30 years. So currently, we have an obligation. We have an obligation. Ob- Obligation in line with the conceptual framework is what? Is a liability, right? If you remember very well, a liability. So a liability is something you are owing, right? That it is probable that you settle it using your economic resource, which can be cash or other things. So now obligation is something you cannot do without. It's something you cannot avoid. So a pension is a liability. That is number one thing I want us to understand. Is a liability you are going to pay in the next 30 years for that employee. That is a pension. Now, for you to now pay that pension, at the end of 30 years, are you just going to wake up? You just wake up one day. At the end of 30 years, you just go and bring money from anywhere. You just go and give that employee the money. No. So you have to plan for that money. You have to keep that money aside. So you have to keep and gather that money aside for you to what? For you to settle that liability in the future. So now when we are talking about post-employee benefits, it will occur in two places. You are going to recognize a liability and you are going to recognize an asset. Now, how does the asset comes in? Now, let me quickly break it down. Now, we are going to settle a liability in the next 30 years. So we have to plan for it. In the next 30 years, we are going to settle Mrs. A. How are we going to plan for it? So we have to keep gathering. We will be contributing some money. Let's say it's a contribution. We'll be contributing it maybe in an account. We are contributing 20,000 every month. 20,000 times 12. That's what? That's let's say 240,000. So in a year, we will contribute 240,000 for that what? For that employee. Now, in 10 years, that will be what? 2.4 million in 10 years. Then times 3 in 30 years, that will be what? That will be 72. That will be 7.2 million. If you press your calculator very well. So invariably, we are going to be gathering money, contributing money, so that we can settle that liability in the next 30 years. And that is how post-employment benefits works. So now, if you are now looking at it, it makes sense. If you look at it, it makes sense. Before we talk about types of post-employment benefits, I'm just trying to paint this scenario. We are gathering 20,000 every month, and that is how our pension works. If you look at our pension, all of us, we have pension accounts, we have ISA account. So do you remember that we usually contribute in line with the Pension Act 8%, right? 8% of our pension, we contribute it into our pension account. Then our employee contribute 10%, right? So 8% plus 10%, 18%, we contribute it in a pension plan. So after the end of our employment, then we are now entitled to our pension, right? And that's how it works. So, and that is it. And that is how pension will work. Now, those pension administrators, those PFA, what they do with our money is that they invest. As we are contributing that money, it does not make sense to save money. It is good to invest. It is good to invest. All this money we are saving in pension, we are just saying our pension is 5 million now, our pension is 7 million. The pension contribution are investing it and they are earning investment income. However, we should take note that investment is very risky. So the only thing we can do is to invest in a risk-free investment. So when we remember our SFL, for the people doing SFL, you remember some investment that are risk-free. So that's just by the way. So that's the gist. Post-employment benefits, a benefit that will be payable after the completion of employment. And that benefit will do what? We bring in two things. Number one is you must recognize an asset and you must recognize a liability. A liability is what you are going to pay in the future, let's say in 30 years time. But pay an asset, how the asset works is that the money you are contributing every month, 20,000, it does not make sense for you to keep it in an account. it makes sense to invest that money. And that is how it's supposed to be. You are contributing, let's say you have in a year now, you have 2.4 million. 2.4 million, you have gathered pension of your employee, 2.4 million. Why can't you invest it in a risk-free investment that will give you at least 10%? So if you invest 2.4 million, you collect 10%, that's 240,000. So that's an investment income coming from that plan asset. So that is how it works. So now let's go. Now, IAS 19 identified two types of post-employment benefits. There are two types. Number one is defined contribution plan, and number two is defined benefit plan. So how does both of them work? Now we are going now. Let's go now. The first thing the standard talks about is defined contribution plan. Defined contribution plan. So what is defined contribution plan? Defined contribution plan are post-employment plan where the employer, please, who is the employer? The organization, right, agrees to contribute a specified or a fixed amount of money in a plan each year, and we have no legal or constructive obligation to pay further contribution if the fund does not hold sufficient assets to pay all employees relating to the service. Please, let's come closer. This is where IAS 19 usually cause wahala. This divine contribution and divine benefit. Please, let's come closer. Both of them are very easy. Divine contribution plan, just by the name contribution plan. What divine contribution plan is saying that the employer, the organization will contribute fixed amounts. Let's say 20,000 that we made mention the other time. They will contribute it into an account. That account is called plan. Let's say plan. So they are now going to be contributing that 20,000 into that account. For what? For the organization to settle, that liability, that pension liability at the end of the retirement of each employee. Please, do we get that? Please, do we get that? I want us to react if you get that. A divine contribution plan. An employee contributes specific amounts into a plan every year. Now, what we are now going to take note is what? Okay, Mr. Folashade, you want to say something? Okay. Okay, let's continue. Now, what divine contribution plan is, let me quickly now put this in. The organization will contribute, let's say 20,000, a fixed amount into a plan each year. Now, at the end of, now let's take note, at the end of 30 years, if the organization has 50 employees, now at the end of that 30 years, if the pension payable to all the employee is, let's say, 100 million naira, all the employee, example, I'm painting a scenario, if all the employees pension contribution, like pension benefit, is, let's say, 100 million. Now, if the organization now has the contribution the organization is contributing, the total amount is now 80. So the employer, which is the organization, they contributed how much? 80 abi. Now the employer does what? Their retirement benefit is 100. If you look at it, it is not up to abi. Is it up to the amount the organization needs to settle that liability? The answer is no, because in this example, the entity has 80 million at the end of 30 years, but the employees all their retirement benefit is 100 million. So that 80 million is not up to 100 million. So there will be an issue, Abi. So now, what defined contribution plan is now saying is that since the 80, since it is 80 million that the entity contributes, the entity will not have legal or constructive obligation to pay further contribution if the fund does not meet that, uh, does not settle that benefit. You know, if you look at this scenario now, the pension plan does not cover it because the organization only have 80 million. It's not up to 100 million. So what defined contribution plan is that there will not be a problem. There will not be an issue because from the beginning, the organization does not have legal or constructive obligation to pay any other money that they contribute. So that is defined contribution plan. But defined benefit plan, let me quickly chip it in. Defined benefit plan is the opposite of defined contribution plan. It is a situation whereby the entity has obligation. That means they have legal and constructive obligation to pay amount that will cover that liability. That is defined benefit plan. That is defined benefit plan. The entity has an obligation to settle, even though that money is 80 million, they must settle it. And that is why in defined benefit plan, there is they call it actual gain or actual loss. So in a situation when we are dealing with defined benefit plan, sometimes the entity will lose, while sometimes the entity will gain. But under defined contribution plan, the entity have nothing to lose. Is that 80 million? The entity will just distribute. They don't have legal or constructive obligation to pay any other further contribution into the fund to settle it. So they will just do what? They will just do as what they want to do. They just try their best. They cannot contribute any further. So if you now look at it, this defined contribution plan is what we are actually using in Nigeria. It's our pension account. The entity does what? They just contribute that 10%. However, the difference is that it's not the entity that is doing what? It's not the entity that is keeping the money. They are dropping the money into the pension account, which is PFA, which are these leadway pension, premium pension, this one pension. So that is defined contribution plan. So now, hope we get that defined contribution plan. Before we go, hope we get that.
Yes.
Hope we, okay. Now, let's quickly go. Now, recognition.
Task I have a short
All
question.
right, all right,
Sorry that I want to take your back.
all right. No alarm.
Can you hear me, sir?
Yes, ma. Go ahead.
Let me be clear. These accounts, these employee benefits,
Yes,
who is preparing the account? Is an entity that is preparing the account.
exactly. The entity is not employee. Oh. It's the entity, the employer. Yes, it's the
Is the
employer.
entity that is preparing this account, right? Okay, number
Yes,
one. Number two,
yes,
I don't understand when you say, oh, if the entity that is preparing the account, how come? So I know that there's a financial obligation that for them to pay the pension at the end of the
yeah,
when they are supposed to pay it. Then the
yes.
liability part for the entity, how come we have the liability part for the entity? That's my question. Then
Okay,
number two question is that these employee benefits, does it go with the current pension scheme that we are currently practicing in Nigeria now? And what I mean is, I believe that your pension goes to a particular organization does not, I don't know, maybe before, organization can keep your pension with them. Then they will not pay you at the end of 30 years when you are leaving. But now I
yes,
don't think I'm a bit confused about presently now. your pension goes to a particular what's it called, this pension
Pension fund
organization.
account. Yes, they
That is
call it PFA. Yes, yes,
they are the one you're having problem with at the end of the day, not your organization.
exactly, exactly.
Now, these are employee benefits. So why is it not speaking to that? Why is it speaking to the old ways of doing pension? So I'm confused a little bit. Are we not
Okay,
supposed to invoke what's happening?
okay. All right, all right. So I've now your question. So number one question is that we are talking about the liability part. On that, like talking from the side of the organization, there is a liability. Why? Because at the end of 30 years that employee is going to retire, we are going to pay her. It is required, it is mandatory, it is compulsory
Sorry,
that
I mentioned liability. I wanted to mention is the asset part that I wanted to mention.
is asset. Okay. So liability is set to liability, asset side. Now, what asset side is saying is that that contribution, now that contribution we are contributing, let's say 20,000 per month, we are contributing 20,000 to settle that liability. Now, what IAS 19 is saying is that it really makes sense. It makes sense to do what? To contribute that money into a fund. That is what they call a plan. That 20,000 where we are gathering in a month is how much? 240,000. In 10 years, I said in a year, 240,000. In 10 years, 2.4 million. So what IAS 19 is saying is that it does not make sense to just contribute that 20,000 in one account and leave it. Why can't you use that money in your plan? They call it plan, it's not account. You know, in our real life, we call it account. You are saving money in an account, 20,000. But in IAS 19, they call it plan. That plan, why can't you go and invest? That 2.4 million, go and invest. There are so many financial assets. There are so many instruments that you can invest on. Risk-free investment that will do what? That will fetch you income, which is called investment income. So, and immediately you are investing in that plan. That means it is an asset. Remember, an investment is an asset. When you have an investment in your financial statement, it is an asset. So that is why they call it plan asset. In IAS 19, they call it plan asset. That money you are saving, you are contributing every month. In IAS 19, it will be assumed that it will be invested. It will be invested. That investment will now give you income. So that is why they call it plan assets and plan liability. So hope you get it now.
Yes, I do.
All right,
Thank you, sir.
all right. So that is how plan asset comes in. It is an assumption that
These
we are
are this
now.
this
Now
thing
let
is
me now
not
go back.
realistic. How many companies keeping money for pension
Now
in the US?
let me now go to your second question now. Now if you see IAS 19 is just like IFRS 2. You know, I said it last week too. I said IFRS 2 share-based payment. Are we using it in Nigeria? If you see any Nigerian company that if you buy something, you now tell them that you give them shares, they'll first of all throw something for you that wetin concern me and your shares. Alaye, hold your shares, Jare. So what I'm trying to explain is that these standards, they are not actually happening in Nigeria. And that is where I'm going. In Nigeria, this is not the asset, this is not the pension plan we are running in Nigeria. In Nigeria, the Pension Act 2004, which is now amended in 2014, if I can remember when I did PSAP then, is saying is that it is not organization that will hold that money, that pension contribution. In Nigeria, I'm not talking about overseas. You know, IFRS is emanate from where? From UK, and it is adopted all over the world. So IFRS is adopted. IFRS is different from what? IFRS is different from Nigerian GAAP. Nigerian GAAP is what? Nigerian generally accepted accounting principle. So in Nigeria, we run a pension plan. How do we run a pension plan? It is not an organization that will keep that money. It is a pension administrator. PFA, pension fund administrator, which are these premium pension and leadway pension and the likes. So that for what? For accountability, so that you are at the end of your retirement, you are going to be what? You are going to be rest assured that I will collect my retirement, because that money is not with an entity. If that money is with the entity in Nigeria, I'm not sure everybody will collect pension, because the entity will just be using it. If the entity is broke like this, let's pay salary in this pension account, they'll just be taking from there, pay salary and buy diesel and do this one. They'll just be using it as an operating, as a working capital. That is how we do in Nigeria. So, but in Nigeria, we use pension administration. That 20,000 that I made mention in this question, in this scenario, it will be used where? It will be saved in a pension in another person's hands. It is that pension fund administration that will now keep your money. At the end of your retirement, they are now going to credit your account with your pension. So it does not apply in Nigeria. This IAS 19 is not what we are doing in Nigeria. And that is what I am trying to explain. Hope that is noted now. So
this defined contribution plan.
Yes.
That one now, can we take it as the voluntary contribution, that pension voluntary contribution?
No.
That's after doing the defined benefit plan, which is 8 and 10. This one is now the voluntary one. Or what's the example of that one?
Like this one now.
Yeah.
This is the employer's contribution. You know, in Nigeria, we have 8%, which is employee contribution, and 10% employer.
Yes.
So when we are talking about that 10%, is this defined contribution plan? It is the employer that will pay it. It is the employer that
it is a fixed amount, but it is not. It has no legal or constructive obligation. They are not obliged to pay it. What if they don't pay?
Now, don't take this one as Nigeria pension. And that is why I don't want to. This is not IAS 19. This is not Nigeria. IFRS is adopted all over the world, though. So don't use it as Nigeria pension. So if you want to use it as Nigerian pension, just see it as what? As that 10% that the employer contributes. That 10% that employer contributes every month. You remember that every month your employer must contribute 10% of 10%.
Yeah.
Yes. So just use it as that. Don't use it as our Nigerian pension. IAS 19 is not our own pen. It's different entirely. It is used overseas. But now, what the Pension Act is now saying is that the employer must do what? Must contribute that 10%. Do you agree with me that employer must contribute that 10%?
That's why I put it in the benefit plan.
Yeah. So divine contribution plan is that if you want to use that, it's defined contribution plan. Because what they are saying, what we said is that it is only that 10% the employer is going to contribute. At the end of your 30 years, if your pension account exceed that 10%, employer, it does not concern them. They have contributed that 10%. It is only that 10% they will contribute for your 30 years. Do you agree with me? Are they going to contribute extra money?
No.
So that is why that fits in divine contribution plan. So that it is only that 10%. They do not have any obligation or any legal or constructive obligation to contribute extra money if the fund does not meet up with that benefit. They only have that 10%, which is that fixed amount. So don't let us, all what we need to understand is defined contribution plan and defined benefit plan. Because if I can set 20 mark question, they will set rating 6 mark, then calculation 12 mark. 6 mark, they will ask you to define what is defined contribution plan and defined benefit plan. Please don't use Nigerian pension. No. Don't use Nigerian pension at all. You just do what? Just understand defined contribution plan. The entity contributes fixed amount of money into a plan, and the entity does not have a legal or constructive obligation to contribute more if the fund does not meet that liability. Simple, shikina.
Okay, contributing more. Okay.
Yes, they are not going to contribute anything more.
But this one, it has legal or constructive obligation.
Exactly. That defined
Contribute
benefit
more
plan.
or to just contribute.
Yes, defined benefit plan, they have legal and constructive obligation to settle that liability. If the liability in the next 30 years is 100 million, they are going to settle it. So that's the difference between defined contribution and defined benefit. They must settle it.
So what's the example of the benefit plan?
So we are going to get there, don't worry. And that is why I said it is not used in Nigeria. Don't use it as Nigeria.
Okay.
Don't use it like Nigeria pension. So now let's go. Recognition of post-employment benefits. Recognition. So according to IAS 19, defined contribution plan should be recognized as an expense in the period they are payable, expected to the employee costs within the as. So what defined contribution plan? The recognition is that 10% that the entity is going to contribute, it must be expensed in the period. It must be expensed in the period. So now, sometimes the entity can pay less. So they are going to account for liability. That means any liability unpaid contribution that are due at the end of the period should be recognized as a liability. Then any excess contribution. Example, we are contributing 20,000. Now the entity now has excess money. They now said, let's contribute 60,000 in this month. So that is prepayment. That is prepayment. And that is what I'm saying here, that any excess contribution paid should be recognized as an asset, because that is prepayment. Remember that prepayment is an asset. Instead of us to contribute 20,000, we now contribute 60,000. So we will recognize that 40,000 excess as an asset, because we are not supposed to pay it yet. So we are not supposed to pay it yet. So that is recognition. Recognition is straightforward. Of defined contribution plan, the recognition, we are just going to expense it in the P&L account. Expense it in the P&L account. If there is any liability, we recognize as accrued liability, which is like accrued expense. Then if there is an excess, then that excess will be recognized as an asset. That is it. Now, measurement of post-employment benefit defined contribution plan. Measurement is very, very easy too. It should be measured based on the amount expected to be paid or expected to be contributed by the employee. So how much are we going to pay? That is measurement. Remember, when we are talking about measurement is how much. So the standard says that it should be measured based on the expected amount that will be contributed. Example, if it is 10%, we are going to be contributing. So the measurement will be 10% on a monthly basis. So defined contribution plan is very straightforward. All what they need is just to expense that contribution. So now let's move to defined benefit plan. So immediately you remember definition of defined contribution plan. The simple definition of defined benefit plan is these are post-employment benefit plan other than defined contribution plan. That means a post-employment benefit plan that is not defined contribution plan. And the standard now portrays is that it is a post-employment benefit where employer defines or specified the amount of benefits payable to the employees after employment or retirement. That is, the employer made a promise. So under defined benefit plan, the employer is going to promise to pay the employee on the level of amount payable to them after the retirement or employment. So can you see the difference now? Defined benefit, the employer promises, they have a legal and constructive obligation to settle that employee's pension liability. That is why they call it defined benefit. Defined contribution plans, e no concern them. It is that 10%. Example, if it is 5% they are contributing, is that 5% they will be contributing. And it's that 5% that they will contribute to till 30 years. And that is how it will work. But defined benefit plan, they are going to promise and they are going to make a provision to settle that pension liability. So it is the employer that will define the benefits that will be payable to the employee. And it's just a simple definition is a post-employment benefit other than defined contribution plan. That means a defined benefit plan is post-employment benefit that is not defined contribution plan. So now, if you now look at this next point now, if you look at my point there, they said the entity has an obligation to pay extra fund. Can you see? Can you see the difference? The difference is very clear. The entity has an obligation under defined benefit plan. The entity has an obligation to pay extra fund into the pension plan to meet this promised level of pension benefits. So this is therefore called defined benefit plan. Can you see that it is very straightforward? One, the entity does not have legal obligation. All it needs to do is just to contribute fixed amount every month. Shikena. But defined benefit plan, if that pension plan does not meet that thing, they must do what? They must pay extra fund into the plan. Hope that is noted. Hope you get that. Defined benefit plan, very, very straightforward. So now, since the entity has now does what? The entity now divides that amount that will be payable, and they have an obligation to pay extra fund. It will be very difficult. And that is why defined benefit plan requires the use of actuarial techniques and assumption to measure the benefits. So actuarial technique is just like a provision, a plan that how are we going to settle these people. So it's like a planning that will be taken into consideration to make sure that plan, when we are talking about defined contribution plan, there is nothing like planning. There's nothing like planning now. Is that 10% they will contribute? And if that 10% meets if the 10% settles the liability, fine. If it does not settle, they do not have any legal obligation. But defined benefit, they must settle that liability. Hope that is noted.
So both of them are fixed. Both of them have fixed amounts to pay.
Now, what defined benefits is now saying is that it's not going to have a fixed to. Defined benefit does not have fixed because even though you pay fixed, you are still going to pay extra. Hope you get that, man. That even though you are paying fixed every month, at the end of the pension plan, at the end of 30 years, you must still pay extra if that plan does not settle your liability. So the defined benefit plan, it is not fixed. It is not fixed. I can't say it is fixed.
So if you don't know that liability, how would you know the liability? Okay, now assuming not fixed that okay, I'm supposed to collect 800. So when it is not up to 800, I will now pay the balance.
Exactly.
Do you understand? That's saying that means it is fixed as well. So you must meet up with that fixed amount. Am I correct?
okay, if you want to use that assumption,
Yeah.
it is defined contribution plan, defined benefit plan. You are the one that will decide how much that will be payable to the employee, and you must do what? And you must settle that benefit. Look at my mouse. Look at my mouse. This is a post-employment benefit where the employer defines or specify the amount of benefit payable to the employee. You are the one that will define it. And what? And you must do what? You must settle it. You will define it and you will settle it. But divine contribution plan, you just do what? You just wake up one day, you just decide that I will be paying 10% of each employee salary into a pension plan that I will use to settle. If that 10% meets it, fine. If it does not meet it, it does not concern you. Hope you get it now, ma.
Yes.
It is very straightforward. IAS 19 is very, very straightforward. One, you just be contributing fixed amount every month. At the end of the retirement, the person will collect her money. If he settles, if it does not settle, it not concern you. But divine benefit, you are the one that will specify and define that benefit that will be payable to the employee. Example, you can say, okay, if an employee can work for me for 30 years, if you can work for me for 30 years, I will give you 10 million naira at the end of your 30 years. You see that you are the one that define it, right? And at the end of that 30 years, you must pay that 30 million. That is defined benefit plan. How you are going to pay it, you don't know. But yeah, you must pay it. You define it and you pay it. But defined contribution plan, you just define 10,000. Let's say I'll be contributing 10,000 or 20,000 for 30 years. So any amount that 10,000 be in the next 30 years is what the employee will collect. Is that 10%? You at the starting, you are not the one that will define it. So hope that is noted now.
Yes.
Hello, sir.
Yes, ma. Yes, ma.
Okay, sir. So that means what you are saying is that
Network. Oh. We cannot hear.
Divine contribution and benefit.
Yes.
The percentage or the amount to pay. Oh God.
The network.
Hello, sir.
Yes.
If you can't hear me, let's just continue. Don't let me say.
Okay. I will continue later.
No, let's continue. Don't worry, sir.
All right.
Let's continue.
All right. So now, let's continue. So now, just like I said, defined benefits plan, you are the one that will do what? You are the one that will define the amount payable to the employee, right? You are the one that will define it. And you must pay it, right?
Yes.
You must pay it. So when you pay it, how are you going to pay it? You must find a way to pay it. So for you to pay it, it is somehow uncertain, right? If you look at it, when you say you pay somebody 10 million naira in the next 30 years, how are you going to pay? You don't know. You just know that you must pay it. So if you look at it, that's why IAS 19 says it requires the use of actual techniques. That actual technique means assumption. It requires assumption to measure that benefit obligation. So now, that now takes us to how that actual assumption is going to be accounted for. And that is where we are now going now. So now we are going to talking about the terminologies of the terminology of IAS 19. Any question you see, you are going to be seeing all this divine benefit obligation, all this current service. So let me pick it one after the other now. So now let's go. Please let's listen very well. Where is this one running? So there are terminologies that we must understand. We must understand, because that's how we are now going to calculate our actuarial gain or loss. So when we are talking about defined contribution plan, there is no calculation. Please, let's take note. Another thing we must take note is that when there is a question on defined contribution plan, there is no calculation. All what you need to do is accounting entries. You just pass accounting entries. You debit your expense and you credit your liability if you have not paid. But if you have paid that money, you debit your expense and you credit your bank because you have paid. And we are going to solve one past question. There is defined contribution, there is defined benefit. I will show you, it is very straightforward. But when we are dealing with defined benefit plan, it is another journey. It is another journey. Defined contribution plan, very straightforward. You debit your expense, you credit your liability. If you have not paid that contribution that you promised to contribute, that fixed amount, you debit your expense, you credit your liability. But if you have paid, you debit your expense, you credit your bank. Now, let's go to terminologies of calculation of and accounting for actuarial gain or loss. Now, number one is what? Present value of defined obligation. Number one is present value of defined obligation. So what is present value of defined obligation? Now, this is the present value of expected benefits payable to the employee after employment or retirement. Now, if you remember very well, I usually say it, that when you have an obligation that you will pay in the future, whenever you have an obligation, if you remember when we calculated the commissioning costs or dismantling costs in IAS 16 or IAS 37, I said any expenses that you incur in the future, whenever you want to account for it presently, you must discount it to present value. You must discount it to present value. I want to settle a liability. How much? 10 million naira in the next 30 years. That liability, if I keep 10 million naira in the next 30 years in my account, if I just leave it, I'm very sure in the next 30 years, that 10 million naira will reduce to 6 million or 5 million. As a result of what? As a result of inflation. As a result of inflation, that 10 million naira will definitely reduce to 6 million or 5 million. Because inflation keeps increasing every year. Even in UK, US, developed countries, their inflation is just small. It's not like obvious like we, that our inflation is very massive. Their own inflation is very small. Their inflation is just small inflation, just little inflation. But inflation keeps increasing. So you cannot keep 10 million naira in a bank account for the next 10 years. You now say that 10 million naira, you now use to buy a car. Let's say a car of 10 million naira today. Because as a result of advance in technology, AI and the likes, if you want to buy that car of 10 million naira, the car will have risen to like 20 million naira in the next 30 years. It is common sense. It is common sense. So when you have an obligation that you do what? That you incur in the future, you must discount it to present value. And that takes us to number one. Present value of defined benefit obligation. That obligation, you must discount it to present value. So when you want to recognize it in your financial, it must be present value. And immediately it is present value, there will be what? There will be an unwinding cost, an interest. An interest will be entering it. If you remember our IAS 37 and IAS 16 very well, an interest will be accruing whenever you have a present value. An interest will be, it is a must. It must accrue. Because it is that interest that what? That will increase that present value to 10 million naira in the next 30 years for you. So that 10 million naira, you will receive it and you spend it as expected. So the first thing is present value of defined benefit obligation. What is defined benefit obligation? that is the liability that you will pay in the next 30 years. Example, 10 million naira you will pay in the next 30 years. That is defined benefit obligation. But because that benefit will be payable in the future, and inflation cannot let you do what? Inflation will definitely occur. So that is why they will discount it to present value. That is number one. Number two is current service costs. Current service costs. So this is the increase in present value of defined benefit obligation. So what current service cost is that? It will increase your defined benefit obligation. Why? Because as a result of the employee working in the future, working in the current period, not future, sorry. So as a result of your employee working in the current example, now I said that we started this pension contribution after what? After 2 years. Now, immediately the employee used 3 years, 4 years, the pension obligation will be increasing, will be increasing, will be increasing. So that is current service cost. Then we have past service costs. This also increase in defined benefit obligation. The increase in defined benefit, present value of defined benefit obligation in the prior period arising in the current period from introduction or changes in the post-employment benefits. So as a result of employee working every year, current service cost is accruing, but past service cost is when you make changes to the plan. So that one too will increase your defined benefit obligation. It will increase it. Now, fourth one is interest cost. Interest cost is what I explained earlier. I said what? Interest cost is like what? Is like unwinding cost. Whenever you have a present value, there must be an interest. There must be an interest. It will increase your present value of defined benefit obligation. It will increase it. So if you look at it very well, current service cost, past service cost, interest cost, three of them will increase your defined benefit obligation. But let's take note. The standard says if the changes to the post-employment benefit result to a reduction in present value, then it will be past service income. It will not be past service cost. It will be past service income. So, but when we look at question together, you see it. Now, we now have benefit paid. Benefit paid. You see that I highlight it. Benefit paid is the amount by the fund manager or administrator or the organization to the employee that have completed their service or retirement. If you remember very well, if there are like 20 people in an organization, all of us cannot retire by the same time. Do we know that? Yes. All of us cannot retire at the same time. Some older people or some senior colleague will retire first before the junior, before the middle level. So as they are retiring, the benefit that they will be collecting is called benefit paid. So that benefit paid will reduce our pension obligation, because let's say for instance now, the total pension obligation we need to settle is 100 million. Now, one of our employee has now done what? Has now retired. We now want to pay him or her. If we pay him or her 5 million, will you reduce our 100 million or increase our 100 million? It will reduce it. It will reduce it. How much? 95 million. So that is why benefit paid will reduce your pension obligation. It will reduce it. Then this benefit paid, it will also reduce your pension. It will also reduce your defined benefit assets, which is otherwise known as plan assets. Plan asset is money you are contributing that you are going to invest, Abi. let's say you have now contributed 120 million. If you now settle any employee that is going, it will reduce your contribution now from 120. If you remove 5, it will reduce you to 115. So divine benefits paid, please let's take note, it will affect your divine benefit obligation and divine benefit assets. And what is divine benefit assets? As I said earlier, I said these are assets, usually risk-free investment. IAS 19 call it risk-free. Why? Do you know reason why? It's because investment is very risky. If you have money, and that is the reason why so many ordinary people that are not accountants, they don't invest to. It makes it like it paid them, make them go bank, go keep that money for bank. It is only we accountants, with our investment analysts, all this, we are accountants, we can advise person that okay, you can invest in this asset and it is risk-free. If you remember your SFM very well, example of risk-free investment is government security, government bond. If you buy federal government bond, your investment income is sure, 100% sure. That is why that's a good example of risk-free investment. The risk is 0%. You will collect your money and you will collect your investment income. Fine. Do you know why? Because it is the government. We are dealing with government. If this government goes, another government will come in. Government cannot die. The only thing that is risk there is that if life ends, nobody will collect money. Federal government will not pay you. You will not pay you. You will not collect your money. But if this life exists, government bond, you will receive your money. That is why they call it risk-free. So IAS 19 says plan asset usually risk-free. That means you invest in an investment that is risk-free, that it is sure that you collect your investment income and you collect your money. That money you are contributing that is accumulating, you will collect it. So, and that is what they call divine benefits assets. These are assets usually risk-free, acquired directly by employers or indirectly through a separate entity for the motive of what? For the motive of settling employees post-employment benefit. So the sole aim of that plan asset, the sole aim is what? Is to settle that liability. And that's why they call it plan asset. That liability, you must settle it. So you go and invest it in a risk-free. Because anytime you want to do what? Anytime you want to settle the employees, it's there you are going to remove that money from. Now, we now have contribution to the defined benefit plan. If you see that I highlighted it, I bold it. This is an investment. This is a contribution. Remember, like I said, there are some money you are going to be keeping, even though it is not divine contribution plan. Remember, divine contribution plan, the contribution is fixed, Abi. But divine benefit plan, the contribution is not fixed. The money you are contributing every month or every year is called contribution to the divine benefit. It will increase your divine benefit assets. Example, as of today, in our divine benefit assets, we have 100 million. If you contribute additional 1 million, it will be what? 101 million. If you contribute additional 5 million, it will be 106 million, right? So we will be contributing. So that contribution will increase our assets. And that's why I highlighted it. So now let's go. Now, investment income. Now look at it. It is called return on plan asset. When you invest, just like I said, you are going to receive interest income. And if you see the standard said what? These are interest, dividend, and other income derived from plan assets during the reporting period. So when you buy a plan asset or you invest in a plan asset, you are going to generate interest or dividend. So that will do what? That will increase the value of your plan assets, which is defined benefit assets. So defined benefit asset and plan asset, they are the same thing. So we have fair value of plan assets. Now, that is where we are now going. What is fair value? You know, when we are talking about defined benefit obligation, we are talking about present value. But when you are talking about asset, it is fair value. Now, what does this mean? Please, let's listen. It's very, very simple. We are contributing money to buy an investment. We are investing our money. We are investing our money. Let's say we have now invested over 120 million. That investment is 120 million. However, when you hire a professional, an investment analyst, you now ask them to help you analyze that investment. What is the fair value? What is the fair value of that investment? Remember that IFRS 9 says that investment, which is financial assets, should be measured at fair value. So what is the fair value? So it is that analyst that will now tell you, this your property, or this your investment, it is now 150 million. Although when what you contributed is 120 million, but the fair value is 130 million. So the difference between that plan, that contribution, that plan asset and fair value of asset is what we call actuarial gain or loss. So when you have an obligation or you have a defined asset, there will be an actuarial gain or loss. So what is actuarial gain? Actuarial gain is when your expected defined benefit obligation is higher than actual benefit obligation. Don't worry, we'll calculate, we'll solve one past question now. Within 15 minutes, we will be done. We will solve past question now. IAS 19 is very, very simple. In fact, I usually pray for it to come out. There's no how you are not going to score at least 10 over 15. No matter how the question is thick. So it's very, very. So actuarial gain, we have actuarial gain, then we have actuarial loss. So actuarial loss on defined benefit obligation, this is when your defined benefit obligation is lower than expected. Don't worry, we will solve questions so that you will see what is defined benefits and dislikes. So now there is something I want us to take note to. This actuarial gain, let me quickly ask a question. When we have a gain on investment, let's say gain on financial assets. No, let us don't use financial assets. Let us don't use financial assets. When we have a gain on fair value of investment property, gain on fair value of investment property, fair value gain, are we recognizing in P or L or OCI?
Gain on fair value.
Fair value gain on investment property. Fair value gain on investment property. Are we recognizing in P or L or OCI?
OCI.
Yeah.
OCI? Okay. What about fair value gain on PPE? Fair value gain on PPE. Where are we going to recognize that one?
On PPE is OCI now.
Then on investment property, IP, fair value gain is going to what?
No, sorry,
OCI.
that one is P&L. No, P&L. For
So
investment property, P&L. For PPE is OCI.
Okay. Mr. Folashade, do you agree? Do you agree with that?
For investment property, P&L. For OCI, I mean for PPE, OCI.
Okay. Two of you are not sitting together. Hope two of you are not copying. These are two of you that you get this tonight now. Okay. So I want to just refresh. Yeah, so you actually get it. You got it right. You got it right. So which is fine. I just want to actually refresh your memory, our memory on IAS 16 now. So Fair value gain on investment property should be recognized in P or L, where fair value gain on PPE is going to our OCI. So, and that is why I quickly want to talk about actuarial gain or loss. So, actuarial gain or loss is going to our OCI. Whether it is gain or loss, it is going to our OCI. So, it's either we have actuarial gain. So, how IAS 19 works is that at the end of your financial year, you must measure your divine obligation. And let me quickly use an example. I think when I use an example, we will understand. Divine benefit obligation. The obligation we are owing, let's say 100 million, or in the next 30 years, we are owing 100 million. So I said that 100 million, since it is in the next 30 years, inflation will not allow you to capture that money correctly. So you must discount it to present value. So when you now discount it to present value, it is called present value of divine benefit obligation. Present value. So when you have a present value of divine obligation, let's say how much? 80 million. You will now find the fair value. You hire a professional that will analyze that divine obligation. What is the fair value? So if the fair value is 100 million, then the original present value is 80 million. You see that there is a difference of 20. So that 20 will either be an actuarial gain or an actual loss. It must be the two. It must be either A or B. So where do we know that we have a gain, or where do we know that we have a loss? It is very simple. Don't let anybody popo it. It is very, in fact, when they wake anybody up, you understand it. Now, this is how it works. It is a gain when our divine obligation 100 million. Example, 100 million. Now, I now hire a professional, an investment analyst, that please help me find the fair value of this obligation. Now, the investment analyst now told me, the fair value of your obligation is 80 million. How much did I recognize before? 100. Then the investment analyst now told me, it is 80. So is it favorable or unfavorable? Let me ask. If I may ask, is it favorable or unfavorable? Instead of me to pay 100 million, the investment analyst says, your obligation is now 80. It has now reduced.
Yes.
So that reduction, is it favorable or unfavorable?
Unfavorable.
Look at it very well. Look at it very well. I'm supposed to pay 100 million. The amount I'm
pay liability.
Yes.
So it's
obligation.
Favorable. It's favorable.
Yes. That is it. Just calm down. It is actual gain or loss. Very simple. You will get it. It's just like IAS 21. If you remember IAS 21, our exchange loss and exchange gain. If you not calm down very well, you can scatter two of them together. But if you calm down, you will get it. That is how actual gain or actual loss works. The obligation is liability. Obligation is liability. Divine benefit obligation is 100 million currently. And now I hire a professional to help me find the fair value. If they now say, the fair value is 80. So instead of me to pay 100, then the fair value is 80. It is favorable for me now.
Yes.
So it is an actual gain. And if you look at my number 10, you see they said this is when the expected divine benefit obligation is higher. Can you see that? That's the scenario I painted. It's higher. I budgeted 100 million as my obligation, but the actual, which is the fair value, is 80. It is gain now. That is actual gain. It is actual gain. Hope you get it like that. It's actual gain. So actual loss is when I budgeted 100 million. My divine obligation is 100 million. Then the investment analyst now measure my benefit obligation. And now, it is 120. It is not 100, though. It is 120. So my debt has increased. My obligation has increased. So which is a loss. So that is a loss, an actual loss. So what? And that is it. And the accounting entries is what? If it is a loss, I will debit my OCI now. It will reduce my OCI loss. Debit OCI, credit defined benefit liability. But if it's an income, I will credit OCI. Remember that OCI is part of equity, Abi. It's part of equity. And when you are increasing an equity, it will be credited. Remember our DC rule now. Debitor asset and expenses and creditor income and liability. So when your equity is increasing, you credit it. When your equity is reducing, you debit it. So that is by the way. Now let's look at actual gain on plan assets. That one is two, just like as we did now. Actual gain on plan assets. My assets, the asset I invested on, that I contributed on, is how much? Is 200 million. And now I hire a professional to help me value my assets. The asset, they now told that my asset is now 250 million. Is that not a gain? It is a gain now. I mean, I thought that my asset is 200 million. Then the person now told that my asset is my asset is 250 million. That is a gain. Then if it is lower, it is a loss. So when you look at it, this is when the defined benefit asset is higher. So this is actual gain. I think this is an error. This is gain. So let me change it here. It's straightforward. So this is actual gain. So this is higher.
So you send this to us when you're done, eh?
That is sure now.
Thank you.
Sure. This is higher than the actual benefit assets. This is higher. So we debit our defined benefit asset, we credit our OCI. You know it is an income, it's a gain. Then this is a loss. This one is lower. It's lower. So that is it. IAS 19 is actually sweet too. Very sweet. It is not something that is chow. In fact, I can say it is somehow simpler than employee benefit IFRS 2. It's somehow simpler. So hope we have solved question on IFRS 2 that I say you should solve. Have we solved past question on IFRS 2?
Not yet.
Hey, time is going. Ọjọ́ máa ń lọ. Ọjọ́ ń lọ. I say you should solve at least one more. At least one more or two more. Ọjọ́ ń lọ. So now let's quickly look at the past question. There was a question I see that we can solve within 15 minutes. So that then the next one we can look at it. So look at this question. This is 2017. The one that was set last, that one is like a 6 marks question. Is it 6 marks or 8 marks? And I don't want us to do that one in the class. It's just like a written. And I don't want a situation whereby I can now test question like 15 marks question. We will not be able to do it. So that's why I'm solving this one. The one I'm seeing, they are not full question. So this one is the full question. It has defined contribution plan. It has defined benefit plan. So this is the question. So I think I snapped the question. Let me send it to your group. So that because I'll present my Excel sheet now. Right? I think I'll present my Excel sheet. Let me send the question to you. So that I will send the question. So, okay, this is it. Let me forward it. So, is it Tinubu PLC or Tinubu? Like when I saw this question, when I was preparing for the class, I was just laughing at which question is this like this? Eh? Is it Tinubu? Okay, it's Tinubu. Like all this I can examine. I don't understand which kind of like this. Eh?
Tinubu, Nigeria, they join it together.
Oh, wow. Which question is this one? So Tinubu PLC is a public liability company that does what?
Which year is this, please?
This is November 2017.
Okay.
This is November 2017. Yes, November 2017. So let's just look at it together. This is a public liability company that operates two pension plans. Now, pension plan number 1. The term of the plans are as follows. Are we together?
Yes.
Now, the term of the plans are as follows. Let me increase my size a little. Let me increase it a little because it's somehow small in my face. Okay. So it's okay like this. So, pension plan 1. The terms of the plan are as follows. Now, they said employee contributes 6% of their salary to the plan. Tinubu contributes currently the same amount to the plan for the benefit of employee. Abi?
Yes.
Now, on retirement, employees are guaranteed a pension which is based upon the number of years with the companies and their final salary. Look at it too. On retirement, the employee are guaranteed a pension. That information, is it telling us that it is divine contribution or divine benefit? That information. Employee are guaranteed. Employee are guaranteed.
Guaranteed, that's defined benefit.
Exactly. That is it. Since they are guaranteed, though, it is divine benefit.
Yes.
So that is what they are telling us. Oh, this is not an Excel. Now, okay, let's continue. This plan was closed to new entrant on October 31st.
I'm not seeing it again.
Don't worry. I want to. Okay.
Okay.
No more. Don't worry. I'm coming. I'll present it again. Okay. So this plan was closed to new entrant on October 31st, 2016, but which was open to the future service accrual for the employee already in the scheme. The following details relate to the plan in the year October 31st, 2017. So present value of obligation as at November 1, 2016. That is the opening divine benefit. That present value as at 2016, that is the opening. That is the opening divine benefit obligation. Okay. Now, present value of obligation as at 31st December 2017, that is the closing.
Yeah.
We should take note. In the question, they will give you opening and closing.
Okay.
So in 2016, that's the opening. Then in 2017, that's the closing. Now, fair value of plan assets on November 1st, 2016, that's the opening. Then the fair value of plan assets on October 31st, 2017, that's the closing. Now, we now have current service costs. Just like I said earlier, I said current service cost. It is a cost that will increase our divine benefit obligation. It is a cost that will increase it as a result of the employee spending more years in the company. So it will increase our present value of obligation. Now, benefit paid, pension benefit paid. This is the benefit that is payable to an employee that has retired happy, it will reduce both our defined benefits obligation and defined benefits asset. Now, contribution paid to the scheme is your contribution paid to the pension, which will increase your fair value of plan asset. So let's go first. Let's go.
That's the employee or employer's contribution. Which one?
This is employer contribution.
Okay.
Employer contribution. Now, they said actual gain or loss are recognized in the statement of comprehensive income. We already know now. Maybe we know. We know now. They don't need to tell us. We know. Now, pension plan. Under the pension plan, under the term of the plan, Tinubu PLC does not guarantee any return on contribution paid into the fund. The company legal and constructive obligation is limited to the amount contributed to the fund. So this pension plan, is it contribution or divine benefits?
Contribution.
Exactly. Very straightforward. The following are details to this scheme. Number one, fair value of plan assets as at 31st of October 2017. Contribution paid to the company October 31st, 2017. Contribution paid by the employees. That 10 million, number one, is by the employer, by the company.
Yeah.
Then the second one is employee, 10 million. The discount rate for the two plans are 6% and 5%. And this will be used to calculate our investment income. Our investment income, this is an interest payment. This is what will be used to calculate it. Now, let's look at it required. Let's look at the requirement. Explain the nature and the difference between a defined contribution and defined benefit with specific reference to the company, company's true scheme. So they ask us to explain what is defined contribution plan, defined benefit plan. Then we should give differences. What are the differences between the two? Abi?
Yeah.
Now they say show the accounting treatment for the two Tinubu PLC pension plan. What is the accounting treatment? So accounting, how are we going to account for it? For the year ended 31st December 2017 under IAS 19, which is employee benefit, 15 marks. So just like I said, when you want to solve employee benefit, please don't let us focus on only written or only calculation. You must focus on both written and calculation. It is very, very important. So now let me quickly present my Excel and let's solve this question. Okay. So I'm coming. Let me show my Excel. So let me show my Excel now. This is not my Excel. Why is my Excel not showing? Voila. Hide. Sorry, just give me 1 minute, please. Where's my Excel? Okay, this is my. I'm sorry, Charlie. I'm sorry. Where is my Excel not showing here? Oh. Okay, now it will show now.
Okay.
Okay. Oh yeah, this is my Excel now. You can see my Excel, right?
Yes.
Okay. So this is my Excel. So now we are going to create two sheets. Sheet number one will be the solution sheet. Worksheet number 2 is for workings. So they ask us to do what? To show the accounting entries, right? Accounting entries. Please, let's check our group. I've sent that question to the group.
Okay.
Yes. So let's check. So now this is it. See, Bond PLC, right? So now in our financial statement, we must show two things. We must show our statement of comprehensive income. We have statements of profit or loss. Then at the same time, we must show our statement of financial position. So in our statement of financial position, we must show our plan assets and plan liability. However, IAS 19 says we can report at net. That means you can bring your obligation and assets together. Then you now minus it from each other. You now recognize at net. Or you can leave it. It's your choice. So let's just do it like this. So this is our financial position and statement of profit or loss. Now let's create a working, right? So if you want to work, so this is it, working note 1. Working note 1. Working note 1. Sorry, excuse me. Thank you. Thank you. So this is calculation of actuarial gain or loss. This is where we determine maybe we have actuarial gain or loss. And it's very, very straightforward. So, Mr. Folashade, I just need you to just give me figure in the question.
Okay.
You know, they give us some information in the question.
Yeah.
So let you just give me the figures. Now, number 1 is obligation. This is on obligation. Obligation. Then we will now determine assets too. So it's copy and paste. We just bring our assets here. So this one will be assets, divine assets and divine obligation. So this is divine assets. Why this one is the divine obligation? Or we can call it plan obligation and plan asset. All join new, all of the above new. There's no name you call it that the examiner will penalize you. Now, in that question, they gave us the first one. What did they give us? They gave us
present value of obligation.
Okay, present value PV of obligation. It's like they gave us data.
Yes,
So
November 2016.
Okay, November 2016, right?
Yes.
Yeah, how much is it? Equally
200.
200. Okay. Now, what's the next item?
Present value at the end. That's October 2017.
So this is what we are now going to do. In the exam.
Sorry, are you writing?
Can you see my Excel?
I can see your Excel, but I can't see anything you're writing.
Really?
Yeah, I don't know. Maybe
wow. Okay. Sorry. It is this Excel. Let me stop sharing. I have 2 Excel on my screen. Sorry.
Okay.
Thank you for just calling me Gary. I have two Excel. So when I was trying to open that Excel, I have two then. So I'm presenting the second one. So let me quickly present the first one. So this is it. Okay. So this is it. Hope you can see it now.
Yeah, I can see it now.
Okay. So now, let's quickly go about it. So divine benefit obligation and divine. So we have opening and closing, Abi.
Yes.
So this one will be closing. November 2017, Abi.
October 30, 2017 is the closing.
October, Abi.
Yes, October 2017.
October when? 31st, Abi.
Yes.
Okay. Now, how much is that one?
240.
240. Okay. Now, what's the next item?
Fair value of plan assets.
So now let's do it like this. So we now bring this one here now. You know, this is working note 2. This is another working note 2. So we are determining the actual gain or loss on divine assets. So this one is fair value, Abi.
Yes.
Let's use FV, fair value. So how much is this one? Egoli.
190.
Okay. 190. Let me copy this naira. So this one is, sorry, I need to insert this. Okay. Okay, this is 190. Okay. Now, as at 31st closing, how much is it?
225.
225, Abi?
Yes.
225. Well, this one is 2 is fair value. Please, let's remember. When
And
it is
it's plan asset, not obligation.
fair value of assets. Plan asset. Okay. So this one too is
plan asset.
Okay. So we are done with that, Abi?
Yes. Current service cost.
Current service cost. Please don't forget our current service cost. It is a cost that will increase our obligation. So current service cost, Abi?
20.
So what about plans past service cost, Inko? Where is that one going? They are
Past
together.
service cost. The same place too.
The same place. It will come into your development. How much is this one?
But there's no, okay, is it the total contribution paid that is planned service cost?
No, in this question, there is no past service cost.
No past, yes, no past service.
I'm saying if there is, in case in the yes. So,
this one is 20.
How much? 20, Abi?
Yes.
Okay. Then the next item.
Pension benefits paid.
So, pension benefit paid. It is called benefits paid.
19.
19, Abi?
Yes.
So this will affect both your assets and your liability. So what are we going to do? We will copy and paste. It will affect both your assets and your liability. Both.
Okay.
Both of them. This benefit paid, it will affect both of them. Please don't let us forget. Now, what's the next one?
Total contribution paid to the scheme for year to October 31st, 2017.
So it is called contribution paid. That means what we are contributing to the plan every year. So it will increase your assets. Remember, the money you are contributing, the money we are contributing every day, it will be increasing our asset, Abi.
Yeah.
So that is it. How much is it, Egole?
17.
17. Okay. Sorry, 1 and 7. Now, before we now close shop, there is something we must remember. Please don't let us forget. Don't let us forget. Interest income and interest costs. So now, in the question, please help me check. Interest expense, that one will increase our liability. Whenever you have a present value, you must accrue for interest expense. It is called unwinding cost, unwinding cost. So interest expense, they give us a percentage. Egoli, how much is the percentage? They give us 2%.
Okay, October 31st, 2017 is 8%. I mean 6%. While November 2016 is 5%.
So now it is that November. You know, this is opening balance. So that interest, income, and expense is going to affect. So which expense, which interest is 20? That 2016 is 5%, Abi.
Yes.
So it will be 5% of this present value, that this opening value, which is this 200. It will be 5% of this 200. Then this one, immediately we do copy and paste, copy it. Under asset, it will be income, investment income, because we invested. So this one will be investment income. Now will be investment expense, interest expense. So, but this one will not be 200 though. It will be 5% of this. Please, let's take note of this opening balance. You know, this opening balance is 200, Abi.
Yes.
So this one is 190. So we need to change this to 190. We need to change this to 190. So 5% of 200 is how much? Is it not 10? 10% is 20. This one is 10. I know this one. But please tell me this one. I think it is 8.5. Am I right?
Let me check.
19 divided by 2.
19 divided is 8.5.
8.5, Abi?
Yes.
Okay. Is it 8.5? 9.5. Sorry, 9.5. 19. 19 times.
9.5 is 9.5.
Yes. So that is it. But we must take note. Now, this interest expense, we are done, Abi. Oh,
Yeah.
are we done with all of them, Abi?
Yes.
So now we can now calculate. If we calculate, this one will be 211, right? This is a 211. This is, then if you calculate this one, it will be 197.5. So this is what I'm telling you the other time, that we will compare. So this present value as at the end, it is the professional that will give you. This is that professional. That example I cited is the professional that will give you that. Wait, this is the fair value of the obligation. This is the calculated value. Let's call it calculated value, or they call it expected value. But in exam, don't let everything to scatter out. Let's call it calculated value, because if you call it expected value now, another wahala can happen. So calculated value is 211. So you now compare. Now, yeah, let's look at it together. Is it actuarial gain or loss? Let's look at it together. Our obligation
is 211.
Is 211. Now the professional now told us, the fair value, the present value is 240. Is it actuarial loss or gain?
Loss.
Loss, Abi?
Yes.
Very straightforward. It is not something that is jow. When you just look at it, it is loss. So it is called actuarial loss. Actuarial loss. So what are we going to do? We're just going to do this minus this. So our actuarial loss on divine obligation is okay. Because it must be loss, let me choose this minus this. So it must be loss. So this is actuarial loss on divine obligation. or divine obligation. This is actual loss. Now, let's now do this one. This is asset, Abi.
Yes.
Let's determine, is it a loss or gain? So this calculated value, let's copy here and paste here. So now, fair value on, now the person told us, so now, and for it, and there is a way my lecturer told me, for you to make life easy for yourself, if you want to make life easy, but me, I just want us to understand. But let's look at it together. Is it loss or gain?
Gain.
Our gain, Abi.
Yes.
So it's actual gain because the fair value is higher now, Abi.
Yes.
Is higher. The fair value is higher. So the fair value is higher than this. So it is higher. So this is fair value, actual gain. Actual gain on defined assets or planned assets. This is our workings. So we have determined the actual gain or loss. So this is our working. And immediately you are done with this, the work is done. So what we need, the examiner said we should do what? It should show our what? He said we should show our accounting entries, and that's why I opened our solution page. So in our statement of profit or loss, what are we going to report? We are going to report some things. So what are we going to report? Look at it. This current service cost, we are going to report it. If you look at benefit paid, it affects our assets and it affects our liability. Shabi, if you look at it, you are not going to report that one. So the first thing we are going to report is our current service cost. So current service cost will be reported in your as one of your operating expense. It will be reported naira in million. So in your profit or loss. So another thing we are going to report is your interest expense. So our interest expense, we actually interest, we are going to net it. We can net it and we can show it, but let's just show it. Let's show it. So how much is our interest expense? Let's copy
10.
it. 10,
10.
Abi.
Yes.
So let's just pick it like this. You just paste it. So these are our interest expense. What about our interest income? Egole.
9.5.
9.5. So this one is minus. So it must be in minus. It must be in minus. So our interest income, 5% of, is it not 195?
190.
190. Okay.
9.5.
9.5. That will be 9.5. That one is income, so it will not be in negative. So what do we need again? That's all. So we report our current service cost, we report interest expense and interest income. That's what we report for in our income statement. We are not going to report contribution paid. So the standard says you can report this one at net. You can report it at net. What is the difference? Is 0.5, Abi?
Yes.
Is it 0.5 negative or positive?
Negative.
So negative, Abi?
Yes.
So you just come here. You can put it here. So this one is 10. Why this one is 9? So that difference is 0 minus 0.5. We can report it at net. can report it. The standard say you can report it at net. So
what if we don't report it at net?
There's nobody that will take you. If it is your choice.
Okay.
It is your choice. It's either you report it at net or you not report it at net. Anything that you like. Nobody will owe you. So on our statement of financial position, now in our statement of financial position, what are we going to report? We are now going to report this present value of obligation. That end own at the end. So we are just going to report them. So we are going to report this 240.
You're supposed to put on
This 240 and that asset. How much is the asset?
Plan asset.
Plan asset.
That's fair value of plan asset, or which one?
At the end.
At the end.
Yes. 225.
225.
Yes. So we are going to report it. So this will be our assets. So there are some assets. That's why I said it at the beginning of our lecture. I said there are some assets that will exist in your financial statement. That you look at it that which asset is this one? Number one is plan assets. Number two, deferred tax assets. These are assets that are not PPE or something. They are assets that you show. The another one is ROUA, right of use assets in IFRS 15. Sorry, IFRS 16 lease. So, and the standard says, what do we do now? We reported this one as an asset, right? This is an asset. Then this one is a liability. Then the standard now says, if you like, you can report at net. You can bring the two together, then report it at net, if you like.
I don't like.
You don't like that one, Abby?
Yes, let's spell it out very well.
That's what the standard is saying, that if you like, you can report at net. You can join the two together if you like. It is your choice. Nobody will owe you. So this is what the examiner say we should do. It's just, that is it. That is the major thing. Then B, look at B now. What did they tell us? They said B. When we look at that B together, maybe if you remember very well, they said the pension plan B is defined contribution plan. Do you remember?
Yes.
And they said, what is accounting treatment? It is very, very straightforward, because the employer will just do what? They will just contribute. So when we are talking about B, this is how we are going to report B. Let me just put B here. So let me copy this. Let me just copy this. So under B, we are just going to do what? We are just going to report only the expenses and the liability. So this is just it. So under the P or L, remember that they said the employee contributed 10 million. The employer contributed 10 million, Abby?
Yes.
So under bill, the employee will contribute. The employee contribution will be deducted from where? Will be deducted from their salary, Abby?
Yes.
But the employer, it will be expensed. So contribution paid by employer. That's what you report in the financial statement. So that is just it. So since
so employees will not show.
It will not show, and that is it. Because it will be deducted from their salary. It will not show. So it is, and when you are conversant with financial statements, it is this employer pension that usually show as an expense. It's this employer. It is the only one that will show as an expense. The employee will not show. So what we can report in this financial position is Has it been paid? Have they paid it? Let's check. Have they paid it?
Pay.
Let's check together. Have they paid it so that we can put it in
Contribution
liability?
paid. Yeah, it was paid.
It was paid, Abby.
Yes.
So we just put it in bank. In bank. So let's put it in bank. Where did this one come from like this? Yeah? So we can just put it in bank. So that is just by the way.
What about the fair value?
You know, that is just a trap. We don't need it to. That is it. You don't need anything about that fair value. It's a trap. All those 5% and 10% is the trap. We don't need it to.
Okay.
We don't need it. We don't need it at all.
So if we have not paid it, it will be liability.
If we have not paid, yes, exactly, it will be liability. If you have not paid, we just come to our statement of financial position here. We just put it as a liability. In fact, I think if that is the situation, but in this question, it's like they told us now.
They said contribution paid. That means
it has been paid. So you can just, what is this one doing?
You can scroll down.
So contribution paid should just be, you just put it to the bank. Chicken now. So please let's check past question and the likes. So let's put current assets. Okay, do we have any question? So for now, at least we are fine for IAS. IAS 19 now, at least. So what we need to just do is just to check past question. I think the last one they said last, that one was like straightforward. So since it has been paid, you just put it as bank here. So that is just it. That is IAS 19 for us.
So I don't understand. We put it, we debit bank.
Credit. We paid. Something we pay, credit.
Oh, okay.
If we receive, we debit.
As if is debit. That's what I'm asking.
So it is credit. We will debit our expense. Like an operating cost, we debit it. Then we credit bank since we have paid. If you have not paid, we credit liability, which is pension obligation. So that is just by the way. After 11. Okay, we are fine. So let's call it a day. Let's call it a night. Sorry, it's a night. Let's go and rest. So thank you very much, everybody.
Thank you very much.
You are welcome, ma. You are welcome. So our class continues when it continues. So that's
it.
When it continues.
Abina. All is well. All right. Good night, ma. Good night.
Good night, everyone.
Good night.
Let me say good night.
Good night. Bye bye. Good night.
Bye. Thank you.
Bye bye.